I'd like to talk first about gold and more particularly about commodities. This chart is created by taking the Goldman Sachs Commodity Index that's indicated by the GSCI and dividing it by the S&P 500 index. And it's going from 1970 forward to present. And what the product of dividing the commodity index by the S&P is a number, and the higher the number, and you can see the peaks in red, at that point commodities are expensive and equities are cheap. So it's looking at relative value between commodities and equities. So the reds are denoting the high points for commodity prices relative to equities. So at that point, you'd probably be buying stocks and selling your commodities. And the greens are showing low points, where commodities are cheap relative to equities. And you can see that there's been 4 low points, and the one over on the far right is the lowest point in the last 47 years. And that's telling us that, well, maybe commodities are going to get cheaper, but there's not much more downside, and it appears more that it's bottoming and it's starting to turn up. And you can look that there is a 10, 12-year average or more time between those lows. So if we're bottoming, one might come away from this graph and say we may have 10 to 12 years of good markets ahead in commodities. Now, the Goldman Sachs Commodity Index is it's largely comprised of energy, then agriculture, then metals, and gold and silver represent about 2% of that index. So it's not just talking about gold, it's talking about commodities. And another way of looking at it is that's telling us inflation's coming. And it's going. This is late cycle movement where your metals and your commodities start moving as you're getting into the late cycle of an equity market. Now, if we move, and let's look at gold for the moment, and particularly gold stocks, we're looking at a period here that covers 77 years of history. And we're looking at bear markets in gold shares using something called the Barron Gold Mining Index, and then some extrapolation in earlier years. It's going from 1939 to present, well, to the end of the last cycle. What I want to show you is that the bottom line is the duration in weeks, and you're starting at unity, and you're coming down, and so you can see how deep some of these bear cycles have been. And this is the last cycle that we were in. It ended in January of 2016. And you can see it was one of the longest, and it was one of the deepest of these. And now we're looking at bull markets in gold shares. So here you're looking at a shorter period, but only 2 years shorter, 75-year period from 42 forward. And if you look at this graph, again, it's duration in weeks on the x-axis or the horizontal, and percentage gain on the y or vertical axis. If you look at those 6, you can see that 4 of them had gains of 600% or better from bottom to top. Now, right now, this is where we are today, that our bull market in gold shares started at the beginning of 2016 when gold was down around 1040. And if you said, well, let me see, 4 of the 6 prior sessions went up 600%, we're up about at the point of 200%. So from here up to 600, it's a 3x move. And since it's 4 out of 6, there's a 67% probability we'll get a triple from these levels before this cycle's over. Now, a lot of people look at gold in dollar terms, American dollars. Some look at it in loonies. But it's really important to understand that when you look at gold in terms of other currencies, you can see that there's a very big difference in performance. So in this chart, on the left-hand side, we're going from the beginning of 2016 to present. And you can see the various currencies. The top one is Argentina. And that's what's happened to the price of gold in Argentinian pesos. It's up 120%. The Turkish lira is up 90%, the gold price in Turkish lira. Even in US dollar terms, it's up better than 26%. And this has all been going on, but no one's really paying attention to this. But it's moving. And it's happened like this before, back in 2006 and then back in 2001, when it started moving in other currencies, but not in the currencies of the major markets. Now, gold equities are very underowned by anyone's definition. But just to give you an illustration of that, looking at the top line of $31 trillion represents the total market capitalization of all the public companies in the United States, all the listed public companies. $31 trillion. And the S&P 500 companies, of which there are about 502, represent 80% of that value, or $24.8 trillion. Now, if you look at that and say, well, there is only one gold stock in the S&P 500, and that's Newmont. And it currently has a market capitalization of $21 billion. And if you were to express that $21 billion as a percentage of just the S&P total market cap, it's 0.08%. So just to get to a 1% weighting, you would need 11 companies the size of Newmont, and include Newmont in that, to get to 1%. So it's underowned. It's near the, gold is near the bottom. If not, it appears that it's starting its bull cycle. The cycle is going to last for a while. The downside risk, from my perspective, is very low, and the upside is a triple from here. Now, there were times when gold stocks were the ownership was more extensive. If we go to 1938, and looking at homestake, and that in the center column we've used homestake is the first 3 years coming down, descending order, and then we had to use Newmont because homestake disappeared. But those were the big gold stocks in the United States. In 1938, homestake was one of the largest companies on the New York Stock Exchange, and as a percentage of the total value of the New York Stock Exchange, it was 5%. You can see it got to 4.5 in 87, and then 2000 got down to 2%. Right now, today, it's 0.08%. No one owns gold right now, but there are some issues to be concerned about. But before that, so our goal, McEwen Mining's goal, is to qualify for inclusion in the S&P. And you might say, why would we want to do that? Well, the American market is the largest market for gold shares in the world. It's the largest equity market in the world. If you look at the changes that have happened in the equity markets over the last 10 to 15 years, you've seen the dominance of banks as taking over the brokerage community. You've seen the security regulators, particularly in the US, putting up bigger and bigger barriers to keep Americans from buying foreign companies, particularly Canadian or Australian mining companies. Just harder and harder to buy them. And a large part of the trading today is done by computer trading and passive investment vehicles. Better than 50% of the trade on a daily basis is happening through passive investment vehicles. So more and more of the money is being driven by index investing. The S&P represents 80% of the value of all the money there. There are 500 companies, there's one gold stock there, and 99% of all the precious metal companies in the world, producers, can't get into the S&P 500 by virtue of where they're incorporated. McEwen Mining is a Colorado incorporated company. It is one of 3 companies behind Newmont in terms of production. There's Coeur, Hecla, and ourselves are the next 3 largest precious metal American producers. So our goal is to get there. It'll give you a competitive advantage and a more stable shareholder base and a lower cost of capital. So McEwen Mining, compared to some of the indices, I want to point out another feature of ours. So on this graph, the red line is showing the GDX, which is an index for junior gold stocks. The gray line is showing the GDX, or the GDXJ is the bottom, GDX. Then you have us, and then you have gold. So when you look at this, our beta, which is really how we move relative to the price of gold, according to Bloomberg, is one of the highest in the gold mining industry. It's 2.8 times. And you can see that our share performance is much different and we're a volatile stock, let me put it at that. But we also, when gold is running, we run a lot faster, or have historically. It's not a guarantee we'll do it in the future, but in the past, we've run a lot faster and higher than the broad gold industry. Now, if you want to have a little bit of fun, and I'm mixing a couple of measurements up, but if you said, remember what I said, there was a 3x potential on the gold stocks, and if you put a beta on that, and you just happen to multiply the 2 together, you run over a $17 share price. So it's just one of these silly quirks. But I like looking at it. If you compare us to the Dow or the S&P 500, you can see there in the blue and the red, and our share price, this is since the beginning of 2016. We've outperformed the broad market by a good measure. You might not have seen that. I mean, we've gone up from 65 cents up to almost $5, and then we came back down, and we're sitting around 2. But on a buy and hold basis, it's not been a bad place to be. I guess that's the end of my slides. Okay. There's some risk in the market, and I'd just like to talk about it. In 2006, there were 2 big American investment houses, Lehman Brothers and Bear Stearns, that posted huge earnings in that year, and that was driven by the size of their derivative book. 2 years later, in 2008, both companies collapsed in bankruptcy, and they blew up because of their derivative books. And derivatives are, as Warren Buffett said, they're instruments of financial destruction. They've only continued to grow in size and number since the global financial crisis in 2008. And they're difficult to understand, they're murky. But I saw a red flag on February 5th. I remember that day because it happens to be my wife's birthday as well. But that was when the stock market had a crash, one of the largest drops on a daily record of the Dow and the S&P. And it was down about 5%, a little over 5%. But there were 2 derivative products. They were low volatility exchange-traded notes that almost disappeared in the space of 3 or 4 hours market trading. The market was down a little over 5%. They lost 96% of their value in the afternoon of February 5th. Value just totally evaporated. And I bring it up because there's a lot of issues out there. If you go on to some of the sites on the internet showing you the relative value of the derivative market relative to all other financial assets, it dwarfs it. It's just incomprehensible how big that is and how unknown it is. And that is a risk that's sitting in this market. And if you're feeling complacent about this market and you think about those charts about commodities coming off the bottom, it's worthy thinking of some more diversification. So we had, I keep pushing this. So you heard from Andrew, and he said, we haven't impaired our revenues with metal sales, streaming arrangements, royalties, or hedging. That our balance sheet allows us to comfortably take on some debt, and we're going to have the money we require to complete the funding of the Gold Bar mine by the end of this quarter. And I'll come to more of that. Javier's been talking about how we've been extending our lives of the mines and increasing production. It's going to be up 35% over last year, going in at the end of 2019. If you look at what we're looking at in Mexico, there's a considerable extension of life there that's possible. Black Fox has a short life. And some of the concerns the markets expressed about the company was, one, how are you going to get the money to finance Gold Bar? Are you going to dilute by issuing more shares? We didn't want to dilute by issuing more shares. What we wanted to do was get straight debt, no sweeteners, no convertibility, no warrants, no fees in front of it, no discount to par. It's just straight, simple debt, clean, that's callable at our option. Sylvain came along, and he's had some exciting exploration results. We've really just started exploring at Black Fox. We can see that growing quite a bit. In fact, all the board was just up at the mine earlier this week. But there are multiple targets. The early results are very encouraging. Don spoke about copper, the sleeping giant. And not too long ago, someone passed a report, I think it was RBC put it out on copper, and they said in the last bull cycle for copper that the average sale price of a deposit, undeveloped deposit, was 3 cents a pound. And the peak was 7 cents a pound. We have 30 billion pounds of copper at Los Azules. At 3 cents, that's $900 million. At 7 cents, that's over $2 billion. That's why I call it a sleeping giant. And we're working, and Don's spearheading that drive to turn a remote project into a very accessible project 12 months of the year, and looking at how can we enhance the value of this asset. Our holding costs are low, but that doesn't mean we're going to sit on it. We're going to push it as hard as we can and see how we can improve the value of that. And Nathan, innovation is the key to, it's the future of mining. It's the future of making mining acceptable to the rest of the world that currently doesn't view mining as a practice they want to see going on. There are ways to lessen the impact on the environment, even improve the environment from what it was before it started, to reduce the costs of production, to increase revenue, and to broaden the revenue mix that we can get at. It's an exciting space. And we've been 6 years since we put McEwen Mining together. I think we've made a lot of progress, but it's been behind the scenes. And as Javier said, this was a year of consolidation, and we're stepping forward. And I see only good things coming out of this. So if you look at McEwen Mining, first our goal is to become one of the very few select companies that gain admission into the S&P 500. In order to do that, we're going to have to not only grow our own operations, but we're going to have to look for M&A opportunities. And so what does a company qualify for the S&P look like? We need to get our production up and over 600,000 ounces a year. We need to have a pipeline of development projects that will allow us to go through 1 million ounces a year. And we want to do all of this without excessive dilution, without selling metal streams, royalties, or hedging and impairing the upside. And we're a big believer in that exploration is a very powerful driver of shareholder value. When I was running Goldcorp, it was largely exploring Red Lake that was the foundation of Goldcorp. And when I look at Black Fox, I mean, we bought it for 6 cents on the dollar, so we bought it well. But why did no one else buy it for 6 cents? What do we see? What we wanted to do was put money into exploration. We wanted to look at the operations and say, you know, in some ways, this was like a dog chasing its tail. It didn't have enough money, and it was chasing the high grade down to a depth that it became very expensive and time-consuming to get back up to surface. So let's look for opportunities to increase our resources closer to surface so we don't have to travel as far, reduce our costs, explore some of these other areas that will become alternative sources. We have a mill with excess capacity. So we're running on that front. I believe we're disciplined. We raise capital when we see opportunities to grow production and mine life. We see opportunity in buying distressed assets at attractive prices, and we expect to make them profitable. We expect Gold Bar will be profitable, and it will be a longer life. If I look at McEwen Mining in terms of market factors, I believe the price of gold is going higher, much higher, so that's good. We have a high beta, so we'll significantly benefit from a higher beta. If I look at our production growth, it's strong, 35% in the next year or two. It's low CapEx, it's organic. We have good potential to increase the mine lives at El Gallo, Black Fox, Gold Bar. As I said, Black Fox reminds me of Red Lake, and that was a good experience. And it responded well to exploration. And the optionality of the copper. All those factors make me a big believer in McEwen Mining. I have $133 million invested in the company. That's my cost base. And the confidence I have in management and the assets are such that I'm putting another $25 million in US. So I'll be up to just under $160 million. And that's the debt we're doing. I wanted to get the lowest cost of debt for the company and the greatest flexibility. So I'll be providing 50% of the debt that we raise.